S.D. Bullion.
Metals and Markets is sponsored by DNA Precious Metals, a near-term producer of the Montauban tailings mine in Quebec, Canada. DNA Precious Metals trades on the OTC BB market under the symbol DNAP. Win up to 4 2013 Silver American Eagles from the dock by guessing silver's closing price for the month of October. Click on the Silver Giveaway banner on the homepage of SilverDoctors.com for more details.
This is the Doc with SilverDoctors.com. Joining us today is one of our favorite guests, the CEO of Sprott Asset Management, Chairman of Sprott Money, and fondly nicknamed Admiral of the Silver Community, Eric Sprott. Eric, it's great to have you back on the show.
Well, Doc, it's great to be here again.
Well, let's get right into the big news last week, Eric, with the Fed. The Fed really shocked the market last Wednesday by failing to announce a taper to QE. And then, of course, Bullard came out on Friday and said that the Fed, well, now we might taper in October,
Right.
which in my opinion is pretty unlikely, particularly as there's no press conference scheduled for the October meeting.
Right.
Two things I'd like to get your thoughts on here, Eric. First of all, how much longer until the Fed loses credibility among the mainstream? And by that I mean its ability to move the markets just by jawboning in Fed speak. And also, what does it mean for the Fed when a small move in the 10-year from 1.4% to 3% forces the Fed to renege on even a modest 10 or 15 billion per month reduction in QE?
Sure.
So what are the implications of this for the metals as well as the stock and bond markets?
Sure. Well, first of all, when you think back to recent history, I mean, the Fed doesn't really have a lot of credibility in terms of walking the walk. I mean, we're talking about an exit plan in '09. Of course, that got dashed because there was absolutely no way of exiting. And then they threw at this trial balloon of tapering, and of course everyone kind of went there. All the major investment houses suggested there'd be tapering. I personally didn't think there'd be any tapering because just the talk of tapering moved the rate significantly higher, and I happen to believe that they have lost control of the bond market. I was somewhat shocked when Chairman Bernanke at the last Senate hearing, somebody asked, well, what do you think of the move in interest rates here? And he said he was puzzled by it. And I thought, the chairman of the Federal Reserve is puzzled by an increase in interest rates, which I think was a very disingenuous answer. I mean, obviously the market has had various things going on which have caused rates to go higher, and I just don't think he wanted to go there. So in my mind, the Fed never has had much credibility, and I think the fact of non-taper just makes that ever more apparent to everyone. And I guess the one thing that we would look to confirm that, and so far has confirmed it, is the weakness in the U.S. dollar, because I think more and more sort of non-Western central banks would be viewing what's going on in the U.S. as essentially a Ponzi scheme, zero interest rates supposedly, or targeted zero interest rates, and then massive printing of money. And I just don't think that they can turn the tap off, because even by talking the talk, the rates doubled, and I think if they walk the walk, then we would see a dramatic increase in rates here. And there's already been severe carnage in the bond market, and I think the Fed is way more concerned about interest rates than even the stock market, for that matter, because interest rates kill governments and they kill the economy too. And we're going to see the impact of that in housing and auto sales and so on. And in respect of the increase in interest rates, to me, it was more a function of what's actually going on in the debt markets. In July, we saw some very large selling out of China and Japan. And of course, there must be many, many other governments who are selling U.S. treasuries, because the talk of taper caused all their currencies to weaken. And in order to support their currencies, they were sellers of U.S. bonds to convert them into their own currencies. So there must have been a lot of selling. And if it wasn't for the Japanese in August buying something like over 50 billion of bonds in the month, I'm sure that we would have shot well through 3%. And as you and all your listeners, I'm sure, would appreciate, I mean, this cooperation amongst all the central banks is just overwhelming here, whether it's, the Fed supporting Europe through loans to the subsidiaries of European banks, or, the Fed phoning up Japan saying, we got to have someone come in here and buy the bonds, which they, of course, dutifully responded to. And, of course, the opposite will happen if things happen in Japan, that the Fed will be involved. I think the really important thing to bear in mind is we have never printed on a daily basis more than we're printing right now, and all the while interest rates double. So if anybody ever attempted to pull back on it, it might be shocking to think what truly could happen to interest rates as they could revert to the mean. And if we ever reverted to the mean, the economic consequences would be dire. The effect on U.S. deficits would be very, very meaningful. And we already have a huge gap accounting deficit. In fact, I use the word that in my mind the U.S. government's already insolvent. They just haven't faced the day of reckoning yet, but the day of reckoning is coming.
And Eric, what are your thoughts for the metals specifically with gold and silver?
Sure.
Will they start to move here as the market recognizes that the Fed's not going to be able to taper? With this, 2-year correction in gold and 2+ in silver, will it continue much longer? How much longer can it continue? I think I'm of the belief that the market has bottomed a couple of months ago. Gold around 11.79 and silver was 18. So, what are your thoughts about what the metals do from here?
Well, Doc, I go back to what I believe is truly happening here. We are seeing a huge increase in demand for gold. And I wrote a number of articles, now 3 of them, asking whether Western central banks had any gold left. And I thought it was getting quite extreme at the end of 2012. And I think that's why these things that happened all of a sudden manifested themselves in the first half of the year. And of course, the first thing was Germany asking for the gold back, and the Fed saying it's going to take 7 years to get back 300 tons or 330 tons. Even China imports 100 tons a month through Hong Kong. And then other signs of stress in the market, whether it be ABN AMRO failing or, the COMEX inventories declining, the gold forward rate going negative. Pretty well all the dealer inventory at the COMEX has essentially been spoken for. These are all signs of shortages of gold. And I think that, they released this trap door in the paper markets, which was very effective, by the way, in sort of pulling 700 tons out of the ETFs and the various trusts around. And most people can't put that in perspective, but 700 tons in 6 months if you annualize it's 1,400 tons. Well, we only sell on the open markets 2,200 tons a month. That's from mine supply. I'm taking Russia and China out of it because they don't export anything. I mean, that fully was 2/3 increase in the mine supply that all of a sudden hit the market. And I think this was meant to happen. That's why they slammed gold, so they could drain the ETFs. And the other side of what's going on, and of course China's just continued to buy more and more and more, is what's going on in India, where I basically see the central planners have said to the Bank of India, you've got to stop your people from buying gold because we have a shortage. And had the Indians continued to buy the roughly 100 tons a month they were doing, and it was well above that in April and May, we would have a combination of China and India buying more than the monthly production of mining production each month, just those two people. So I think that's why we've had these rather draconian moves in India, because we have a shortage, and it would just be manifested that much quicker if the Indians were allowed in the market. And there's hardly a week goes by, including last week when they increased the tax from 10 to 15%, that the Indians don't keep putting pressure on the gold market. And I think if we could ever get back to normal, we would find out that between China and India, they're buying well over 100% of all the gold produced. And it would kind of open up the question, well, where's all this gold coming from? And of course, the answer is it's coming from these Western central banks who are leasing it into the gold market. And sooner or later, they're going to realize they're going to fail on this because this demand is not going away. Demand will increase. And I think the non-taper announcement will cause it to increase. I think the sort of signs of weakening in the U.S. economy will make it decrease. The fact that Europe's not really recovering will make it increase. The volatility in foreign currencies of the developing markets would make people in those countries want to own gold. The decline of the rupee would make people want to go. There's so many examples of why people should be coming into this market and owning gold in the present environment, above and beyond the fact we've already got more demand and supply that I think, as you correctly state, I think we saw the bottom on June 28th. I think the price is going to rise dramatically here as everyone realizes yet again that these QEs don't work. They don't create any economic growth whatsoever. In fact, we hardly have any economic growth. And that certain segments of the population, the middle class, are just getting in poorer and poorer positions as time goes on here, because there is inflation well beyond what is stated, and of course there's no commensurate increase in income. So I think the outlook for both metals is great. Of course, I think the outlook for silver is greater than that for gold.
You kind of given a perfect segue to the next question, Eric. I wanted to ask you specifically about the GLD drawdown. GLD's seen an unprecedented inventory drawdown throughout the year, as you alluded to, among all the ETFs. I think it dropped from about 1,350 tons in the beginning of the year to a low down near 900. The mainstream narrative among the CNBCs and Bloombergs and so forth has been that the GLD and ETF drawdown is large investors dumping gold and reallocating positions away from the metals. But as you pointed out, you believe, and I'd agree with you, that in reality it was to free up gold supply for a shortage that's been evidenced by the negative GOFO rate and other things. One thing I wanted to ask you about, Eric, if the mainstream narrative was the correct explanation for the GLD drawdown, Sprott's ETF Fizz or PHYS should have seen a comparable 30 or 40% inventory drawdown as well, but somehow I suspect that hasn't been the case, Eric.
Well, of course, for the most part, our units trade above asset value. It was a very, very short time where they traded below asset value, and we had some redemptions, which was perfectly fine. That's what our trust is meant to do. You want to redeem, just put in your notice, and we'll redeem. And we would have lost about 1% of our assets through that redemption. It was basically only one party that did it, because they could buy it at a discount and take the gold at below true market price, and they use that alternative. But I want to go.
So just emphasizing here, you had one person sell about 1% of the ETF's assets.
Yeah. Well, in fact, the one person bought the units and redeemed them, right? And it was a contemporaneous thing. They just bought them because they're at a discount. In other words, they weren't really selling the units, if you know what I mean. They were buying the units and redeeming them to get the gold, because they chose to have physical rather than paper, because they could get it at a small discount. And Doc, one thing I should point out about the GLD. You know, it's fine for someone to come in and buy the shares of GLD. Why did they redeem them? Because they had a use for the gold. You know, if they didn't have to redeem the units, but the fact is that they knew that if they redeemed the units, they could sell the gold, which really means there was a true market for an extra 700 tons of gold out there that was way beyond the normal supply. You don't buy gold you may as well just keep the certificates. Why do you convert it to gold? But the fact is they converted the gold because they had obligations which they couldn't otherwise service. So I think this whole thing was orchestrated. And that's why and of course the mainstream always sell gold. It's not a great asset. Of course, it's been the greatest asset for the last 13 years. But everyone's forgotten that now. But it will obviously reassert itself. And as you know, the premiums on certainly our trusts have gone back up here, particularly the silver premium. I think it's through 3% again. So the interest is coming back. I think with all that we have in front of us, it would seem more and more obvious to more and more people that you should be in gold and silver.
Well, Eric, as you've made the case here that the entire takedown in gold down to 1179 was orchestrated in order to free up supply, and there's even been speculation that the supply was needed to prevent a gold default by one of the large bullion banks. It kind of, if we think back to the time frame that the takedown began, it was immediately after the Cyprus bail-in in early March. And in the aftermath of the Cyprus bail-in, we uncovered documents here at SD about the Bank of Canada, Bank of England, and the Federal Reserve all setting up official bail-in policies for future banking crises. And many throughout, even the alternative media initially scoffed that a Cyprus-like bail-in was possible in the U.S. or Canada. But over the last 6 months, it's become much more accepted. I think even a couple of months ago, Reuters has since confirmed that the Bank for International Settlements has indeed set up what they called a bail-in blueprint to be used by the Western financial authorities in the event of a future financial or banking crises. So I'd like to get your thoughts on that, Eric. What role that might have played in as far as keeping a handle on an explosion in the gold price post-Cyprus,
Right.
and also do you believe a bail-in is possible or even likely in the U.S. over, say, the next 5 to 8 years?
Sure. Well, let's go back to Cyprus, first of all. I mean, it was incredible, and it still hasn't been resolved, by the way. We don't know how much the depositors are going to lose. The thing I found most striking about the Cyprus bail-in, it has never been mentioned in the mainstream media. I think you could even go to Google today, and you will not find it. The only news agency I saw that reported was Xinhua in China. So nobody's any more aware of it other than those of us who kind of all suspect these things because we tracked it down through the web. And then BIS comes out and says, I think this is a number of months ago, we have a simple solution to a too-big-to-fail bank going down. And their simple solution was, of course, the bail-in, where we make the depositors pay for the misinvestments or malinvestments of the banks. And I found it rather stunning that they'd use that word simple. And I guess for the BIS, it's simple. It's not so simple for the depositors. And really, the other governments installing this, I was absolutely amazed when the Canadian government in March put in their budget. I thought, where would this government have come up with that thought to put it in legislation? Which kind of confirms that, all these guys talk to each other. They know exactly what the status of the financial system is. They realize that the banks are over-levered. They realized after a while that the governments who had first supported their banking system stopped supporting the banking system because their rates exploded because they were taking on way too many liabilities. So they all realized they couldn't do that anymore. Well, then they get, of course, the central banks buying all these bonds that then kind of reliquefies the banking system. But there's a limit to that too. Well, what's going to happen after that? Well, I guess we got to go to bail-in next, where we'll just make the depositor pay and we'll just carry on as though nothing happened. And it's a solution for the banking business. It's not a solution for the depositor. It'd be a travesty that would happen. And the fact that everyone so conveniently thinks this is a great solution, it just shows how much they care about the banking system versus how much they care about the depositors who are residents of their countries. They think the banking system is more important than the depositors, which is a disgusting situation to be in. So there's no doubt that they set up for this. We could still have, we've already had lots of carnage in the bond market. If the stock market finally starts thinking that the QE is not really working and the economic numbers get weak and we get a bit of a sell-off in markets here, or if the recession just continues to deepen in Europe, which it looks like it would do in my mind, and then spill over to other countries. In fact, I don't think we have any growth here. I wouldn't be surprised we're in a recession in North America. And then, of course, the markets would go down. So we got a weak bond market, potentially weak stock market. It's devastating for financial institutions that are highly levered. And you need that bail-in to protect the banking system. It's not to protect people, that's for sure. So you can see where this mechanism is going to be used. And I guess we all found it a little stunning a week and a half ago that Poland just seized all the bonds in their private pension funds. The things that we witness every day are so extreme relative to what we're used to, and we could call it bail-ins, bond seizures, zero interest rates, printing money. They're all manifestations of the fact that we have a financial system that's essentially crumbling by the day, and they're just trying to prevent it from happening on their watch. But there's no doubt, I think, just by having this legislation around, they realize, okay, it's coming, and we better be ready for it.
One thing I wanted to point out as far as bail-in, I think the authorities rather ignorantly or mistakenly believe that it won't affect the average Joe that, say, has $2,000 or $3,000 or $10,000 or $15,000 in a bank account because they'll insure up to the FDIC limit in the U.S. or so forth. But it's rather a short-sighted or naive view when you consider to think that all the business accounts that will have their assets freezed, and now you're talking about payroll not being able to be met. In my mind, a bail-in would be a much bigger travesty for the economy than the policymakers have likely even thought about.
No doubt about it. That, when you just take 10% of the deposits, I mean, somebody's lost a lot of money here. Somebody has to report these losses. If you were a company that had money in Cyprus, and let's say you had $1 million there, and next thing you know, they say, well, we'll give you 200,000 back. I mean, you got to record the loss, right? And the same thing would be true, of course, if other countries do that. And to minimize something like that, saying it only happened to a class of people, is naive beyond belief, because, of course, the people that are affected will cause the other class that isn't affected to be affected just by what you're saying, losing jobs, losing sales, whatever. But that's the way they want to approach it, because there's no other way of saving the system. I mean, if you just let it crash, then there is no solution, right? Everyone is trying to sell assets, and of course there'll be no bid for anything, and no one knows how far things will go down. And one of the reasons I know they have this bail-in, ever since Lehman Brothers, which was a liquidation, there's never been a liquidation allowed in the meantime, because of what Lehman wrought at the time. And of course, the liquidation caused all assets to go down. So ever since then, nothing is ever liquidated. Not Fannie, not Freddie, not AIG, not the banks in Cyprus. Nobody's ever liquidated. They're always bailed out. And the same, of course, would be true in a bail-in. The bank doesn't have to liquidate, because they just stick it to the customer. And I think that's why they realized from the Lehman event, you can't have a liquidation, because the props go from underneath everything, and that's why they want to use this bail-in strategy, because with a little pimple like Lehman, it almost took the whole system down, and they just know we can't have liquidations anymore.
All right, well, I'd like to move on a little bit here, Eric, to discuss the U.S. debt ceiling negotiations and rapidly approaching deadline here. I think you informed SD readers way back in 2011 that the U.S. had reached its Minsky moment, and we've probably tacked on another 5 or 6 trillion in official debt since then, and probably another 20 trillion plus in real debt by any true accounting principles since then. Back in 2011, when we had the last debt ceiling crisis, we saw S&P downgrade the U.S. and gold made, I want to say, about a $300 move to the upside in just a couple of months, top out around 1915. I'm not sure we'll see another downgrade this time, as the U.S. government taught an S&P a lesson about that, and they've banned Egan Jones. But how do you see both the metals and bonds reacting to the latest debt ceiling fiasco, and ultimately what'll probably be needing to raise the ceiling to the 19 to 20 trillion range, if they even put a ceiling on it?
Right. Well, I've no doubt they'll come up with a new ceiling. I think it's what the political haggling is over, whether Obamacare is affected or this, that, and the other item is what the real issue is. I think everyone's prepared to raise the debt ceiling, because the whole place would crash if you didn't raise the debt ceiling, so it would almost be irresponsible. To me, the biggest thing is, to what extent does the non-Western banking group look at the U.S.? Should they, tramp around on expenses and really do nothing and pretend they've accomplished something when they've accomplished nothing? Don't cut expenses, just carry on their merry own ways. And as you referred to, I mean, the obligations that the U.S. government incurs each year based on Medicare, Medicaid, Social Security payments. I mean, it grows by 5 and 6 trillion a year, and the piper's got to be paid someday. And people who are not with the Western central banks would realize that having investments in U.S. denominated things is not the thing to do. And I think the biggest thing that we have to be concerned about, one, because of the debt situation, but two, because of the printing of money, is what does the dollar do? Because if this dollar breaks down, which it looks like it has, all of a sudden it unleashes some forces that would have hugely negative consequences. Of course, the biggest thing you unleash is inflation, because everything then costs more in U.S. dollars. So I think that as we watch this debate going forward, today we should emphasize watching the U.S. dollar here. If this dollar continues to decline based on the Fed non-tapering and the budget battle, then I think, of course, the people's reasons to own gold have gone up in now a significant part of the world economy that is dollar-based. So I would think that, of course, the outlook is much improved by a weakening dollar, and I suspect we're going to see that dollar weaken here as this debate rages, and we all realize that just like the Fed, nothing will be done.
Well, before we let you go, Eric, can you tell our listeners about Tuesday's Sprott Precious Metals Roundtable?
Sure.
I believe it includes yourself, John Embry, Mark Faber, and Rick
Yep.
Rule. So where can readers and listeners go to register and attend the event?
Sure. Well, they can just go to Sprott.com and register. I know we've had a huge response so far. In fact, I was informed we have 900 questions have been asked, which I know we won't be able to answer. But one of the reasons we're having this is, all of our people have been outspoken about what's really going on in the world here. And as you're undoubtedly aware, Doc, you go back and look over the last 10 to 13 years, there have been few people that have been outspoken about what's really happening in the world, and I would include all of our participants in that. And for the most part, they've been totally right about what's happening. And I guess our biggest frustration is always gets delayed. I mean, it's obvious what's going to happen. It's only a question of when it's going to happen here. But I think people who take a longer view obviously are going to be very, very safe in precious metals investments, and we just want to convey those feelings in this roundtable and deal with a number of the questions that are going there. So we'd encourage everyone to sign up for that.
Yeah, definitely highly encourage all of our listeners to go ahead and sign up and attend that great opportunity there. And what time is that again, Eric?
It's 2 o'clock on the 24th of September.
All right.
And of course there'll be replays and all that. So, but it will be interesting.
All right, Eric Sprott, the CEO of Sprott Asset Management, Chairman of Sprott Money. Always a pleasure. Great to have you back in the show, Eric. Thanks a lot.
Well, thank you, Doc, and congratulations on all the fine work you've done on your website. And I'm happy to see it's very successful. So, continued success to you.
S. D. Boyan.